Welcome to my channel. I'm Dr. Romano. In today's video, we are going to discuss whether it's beneficial to use insurance products to sustain wealth over multiple generations. Now, there are products out there. It depends what type of company that you purchase those products from. You're able to get insurance if you die or something happens. And some people have mentioned that it is beneficial to use that type of insurance product to sustain wealth over multiple generations. However, I'm going to discuss with you whether it's beneficial to use that methodology or my own methodology. Before we continue the video, please remember to subscribe to my channel, do thumbs up. That will really help me out and propel my channel to increase subscribers. In addition, I'm here for you answering your questions. And if you have any questions, you could send me a message on LinkedIn and I'll make a video just for you. I've received a PhD in financial management and leadership with all of my research, 1,000 pages, on hedge fund selection and operational due diligence, that's risk management. My previous education, my first MBA was in finance, and my second one was in risk management and insurance. I have a college degree, of course, in social science, and I started out at an investment bank on the trading floor for the chief financial officer. My job was to review the trading books on a global basis every morning before he saw them. After that career, I went into commercial real estate where I sold apartment buildings in Manhattan, and I got the privilege to sell a trophy property from the architectural firm McKim, Mead & White. After that, I also went into insurance for a brief time and learned about how different insurance products could actually protect you. However, when I went out to my real estate owners, the people that I dealt with, I seen a very big pullback in their interest in insurance. A lot of the men that I used to speak with, they would say, oh, I don't care about the next generation. The only thing I care about is getting through this one. Another person said, let them deal with it, meaning the next generation. And others were very nice and considerate. But what I realized is that a lot of them were very much control freaks. So they were so hung up on controlling what they had. And that's really scary. Because the older you get in age and the more forgetful you become, the more bad decisions that you make. And you could have the onset of Alzheimer's. A lot of people get Alzheimer's. They don't realize it and they don't really diagnose it until it's too late. Those people who eat a lot of sugar and high carbohydrates have a higher likelihood of having the neurons in the brain crystallize. When the ends crystallize, they can't submit the data to the other neurons, and that's Alzheimer's. That's when you get older and you forget things. You need to protect your assets before you get to that point. Don't try to be a control freak, because you are not going to be a control freak for your entire life. Apparently, you made a lot of money in your career, but to sustain it over multiple generations, you may not very well be capable of doing that. I'm providing this video to you, free advice that I give to the public, and I want to share with you how you can protect yourself in these type of situations. Because if the courts have to take control away from you and give it to your spouse or your children or relatives, that's a very lengthy process, and it may not go in your favor. Leona Helmsley was a perfect example of what went wrong. She was a control freak. She took Harry Helmsley away from his wife, who was a Quaker, and away from his children, and she took his wealth and she gave it to the dog or the cat when she died. She said over her dead body would she ever give it to anybody. That's very scary. Now, these types of people also are They also come in the male equivalent. They're even bigger monsters because they do have a lot of control. And so whether it's a woman or a man, it's irrelevant, but it's the story that takes place over time and time again. I'm a perfect example of this because I have a family member who did just that. She threw my mother in the street with an eviction notice and took everything my parents had. Because my father, he was such a loving, generous person and always trusting everyone. Look what happened to him. So if you don't want that to happen to you, there's a couple of methods that you could do. Using insurance products to protect the estate taxes is a possible methodology, but it's very expensive to have that type of policy, especially if you have billions and millions, etc. I have worked for an insurance company, so I know the different products that they use, but it depends which company. So I don't want to talk about the company or the particular name of the product. There's type of products that you could purchase that when you die, the estate will get a lot of money, meaning the beneficiaries. However, you have to think about, because you created so much wealth, and somehow you either been very, very frugal about it. For example, there was a gentleman in Manhattan in the 1960s and 70s. He actually died in the 90s, but he owned most of the West Village and the meatpacking district. He owned $2 to $4 billion worth of real estate, and that was priced in 2003. So you could imagine how many more billions of dollars of real estate he owned. But because he was older in his life and he started to get Alzheimer's, he didn't manage these properties appropriately, and that's why back then in the 80s and 90s, you would walk around the West Village or the meatpacking district, and it was all falling apart. There were squatters living in these beautiful brownstones, as well as in warehouses in the meatpacking district. So for you to think that you're going to control everything, it's not going to happen because you're going to get old. And so what I suggest that you start off in your career doing this methodology. I've said this multiple times, but you need to create a private foundation. You need to create it in Liechtenstein. The assets are not going to be in Liechtenstein. Yes, they're going to be in America, so it's a safer investment. However, the control of it is in Liechtenstein, but you control it. Now, there's a number of clauses that you could create that they're basically templates. And there's over 500 clauses that you could create and add into your private foundation. Now, I suggest a private foundation because it's an entity that can't be changed. Meaning, once you set the rules into that private foundation, that's it. When you die, your heirs and beneficiaries cannot change it if you put those clauses there. If you want to continue being a control freak, even after you die, that's what you could take advantage of. Now, a trust is not long-term. Yes, it lasts up to 100 years, but a trust is an agreement, and that's all it is. Do not listen to your attorney because your attorney will advise you to do a trust, and he's putting into your brain, oh, but if you put your assets into a private foundation, you can't touch them, you can't get them back. The whole point is to protect yourself. You don't need $1 billion worth of real estate in your name. You're still going to control it and manage it in the private foundation. But if it's in an LLC and you own the LLC, well, unfortunately, depending on the judge, they could go after that. And depending on where you live in the world, which state you live in, just because there's laws in the US, it doesn't always mean that the judges follow them. It depends on the circumstances. So your attorney will basically be going bankrupt if all his clients or all her clients did that, put everything that they have into a private foundation. Now, the Vanderbilts, they were very wealthy. We all know about them. But Mr. Cornelius Vanderbilt, he didn't understand the value of a trust or a private foundation. And if he would have done that, the child, Billy Vanderbilt, that he gave 90% of his wealth to, lost all of it by the next generation. The other 10% that he gave to the other children, somehow they still have most of that wealth. This is the Biltmore estate in the Carolinas, etc. And unfortunately, the other 90% was squandered away because the railroad business seen its peak by the third generation, and they didn't diversify like Warren Buffett has. Have you seen his portfolio? He owns oil, he owns the carts that transport the oil, he owns the company that makes those carts, he owns everything. His wealth will be sustained multiple generations if he puts it into a private foundation. Secondly, it's a tax deduction to put your wealth 30% every year into your private foundation. Then whatever you make for that year, if you made $100 million, then you have to basically pay tax on $70 million, and you take the $30 million tax-free, dump it in your private foundation. The other $70 million, yeah, if you have a company, you could have a private jet. You're only writing off $10 to $20 million a year, so it's really not a lot. And so if you have to do this over your entire life, continually buying private jets, continually buying mega yachts at 350 feet at $100 million, and create a charter company, rent it out to create expenses because it's a loss, you're basically wasting your wealth. If you're paying tax on $100 million, right? Take that amount, that high tax bracket, just for federal, and deduct 11.5% from it. That's how much you're saving by putting it into your private foundation. So if you take the 30% tax-free, dump it into your private foundation, then take the other 70%, pay the tax on it, that's what it is, and then dump that after it's taxed, and you pay the tax and dump it in the private foundation, the following year, the private foundation in Liechtenstein does not pay income tax if you don't live there. So you could find investments that either have a low tax rate to invest in, such as funds of funds, that's a portfolio of hedge funds. When you realize this, that basically in a couple of years compounding interest, you'll make all that money back. That's accumulation of real wealth. Because you're not wasting it, and if you want to be cheap and frugal, which some people are, and it's okay, that's what you could do. Secondly, nobody can take your private foundation wealth away from you. So you literally put the attorney team out of business. Because when somebody sues you, their attorney, the first thing they do is they look on record what you own that's in your name only. That's very scary. And unfortunately, because you are very rich, you are going to get a lot of people that are going to do everything they can to sue and take money from you, including relationships, kids even, friends, family members, everyone. Person that said that you slapped them or whatever the situation is. Meanwhile, it's not true. This is why if you're worth billions, you need to have a security team following you around 100% of the time. It's very important you do this because that's just how it is. Secondly, the children, the offsprings that you've had, every gold digging in the world, every gold digger is going to be haunting them, including yourself, to give them money, to lend them money, family members, everything. So if you've dumped it into your private foundation, you've protected your spouse, you protected your kids from dealing with that. Unfortunately, a lot of people may inherit money, but they're not able to manage it. And so this is why it's better to put the money in a private foundation, meaning your real estate portfolio, your stocks, the companies you own, everything. Because you are a U.S. citizen, you are required to pay U.S. taxes no matter where you live, unless you get rid of your citizenship and live in a country that doesn't have taxation or low taxation like 5-4%, the center of Switzerland or other places. So if you don't want to do that, then you have no choice. In that clause, those agreements, in the actual contract with the private foundation, you can add up to 500 minimum clauses. Some of those clauses state what the beneficiaries could do with the assets. So not only you could protect those assets, meaning if they sell a $100 million apartment building in Manhattan, and the ones that I used to sell, you could say, well, if you sell that building, you have to replace it with the same investment. If you buy a business and you sell it for a profit, then you have to invest that in another business. You are not allowed to borrow from the private foundation. That's a very important thing, because what happens is you will have a child in the future, or even when your spouse remarries when you die, their new gold-digging spouse, or whether it's your kid's spouse, etc., they will convince them to start a business. And somehow, because they are control freaks and they're possessive, then what will happen is they will lose the money, or they'll take half in a divorce settlement. And so these are things that you have to think about, how to protect your children, your future descendants. You are there because you created this wealth to create a legacy like the Medici family did. They owned a bank. The Ford family, the Rockefeller family, all these foundations, the Guggenheims, and the list goes on and on. This is very important. Don't go listening to your lawyer that the negatives that they throw at you about a private foundation. Of course they're going to say that, because they won't be making millions of dollars off of you from protecting you from all these legal lawsuits. Because no one's going to sue you if you have not a dime. That's why people that are homeless, they never get sued. It's the wealthy people that have all this wealth that continue to get sued. Look at the famous people in the past that their spouse said this and that about them, but it wasn't true. Like the actor, what was his name? The Pirate Caribbeans? Like Johnny Depp and many other people. But these are publicized stories. What about all the stories that don't get put in the newspaper? And so using insurance products, yes, it's beneficial, but you have to remember, when you can't afford to pay that insurance product anymore, that policy's gone. And yes, there are types of insurance products called annuities. Depends what company is and what they're calling it, but you still have to pay into that account. And if you stop because you're going bankrupt 1 year, because we have a 5-year horrible economy like the 70s, that was a market change that took place. And it took a while for society to change and realize, if you do have a 3 to 5 year period, that's very dangerous. You will lose all that money that you put into that annuity, as well as that life insurance policy. What if you last until 105? That means that you had to pay the premium until 105. That could be 30, 40 years. And yes, the insurance is cheap when you're in your 30s and 20s, but it goes up and up and up. And unfortunately, the private foundation is a better methodology to use. Yes, you are still in control of the wealth because you're the one managing it. You could also put in the clause that if you start to go brain dead or you have a little onset of Alzheimer's, the chair, the committee could oversee this and follow what's in those clauses. What do you want with the money every year? How much do you want to give to each descendant per year as a pension? Don't just give them millions of dollars, because that money is going to be squandered away. Look what happened to the most richest family in the world, most famous, the Vanderbilts. They're penniless. And yes, the newscaster, I'm not going to say his name, but Gloria Vanderbilt's child, he turned over and said, "Oh, I'm not a fan of it. I really don't need it." He said that because he didn't have it. And unfortunately, his mother, which received $5 million in the early part of the 1900s, she squandered that away too, just as all the other family members. And it's a sad thing that each of these family members, they had to pay estate taxes. So not only do the people who own the mansion in the Carolinas, they had to sell half their property, even more. Again, even in England, these wealthy landowners called dukes and duchesses, viscounts and countess, and all these names, they're penniless today. They can't even survive. They've had to sell their antiques and their houses. Some of them burnt them down because they had to pay 70% estate taxes after the war. That's enormous. And so to avoid that situation, to keep the wealth in one entity, you create a private foundation. And it will last multiple generations if you include those 500 clauses, such as you do for a trust. A trust, you put clauses to protect the trust, and so forth. Look what happened to the Rothschilds family. There was multiple children that moved all over Europe, and the only ones that actually survived were the ones in England. The ones in Germany were killed and lost everything. The ones in France lost everything because Adolf Hitler took everything from them. So again, you have to protect yourself through multiple generations. You never know what happens to a government, whether the party changes for the worst. And that's why owning stocks and real estate and hedge fund investments and companies is wonderful. You cannot take that away if your country has a revolution. This is why I say the diamonds are the most valuable investment that you could ever have, and 20% of your wealth must be in diamonds and gold coins. Even if you're worth $100 billion. I know it's a lot, but think about how small diamonds are and how light they are. So basically, you could get on a private jet when there's a revolution, and you could go to another country and escape. And to protect your wealth, you can't take the real estate with you, you can't take the company stock with you, and you can't take everything else you had, all the art, unless it's small. And so I highly advise people to buy diamond certificates. It's an actual certificate, and on that certificate is a serial number. The serial number is engraved on the side of the diamond, the actual brim of the diamond. And who certified them but the Gemologist Institute of America? Of course you trust America, not the international one. Because these diamonds are in a credit-sized certificate, sealed with a plastic. It's there. You know what it is. You know based how much they're worth. And diamond values never have gone down throughout history because it's controlled, just like gold used to be controlled before it was commoditized. And so all these things you need to think about. This is why the Maharajas of India, they wore the diamonds, the men and the women, on their neck and on their body, because they never knew if their brother or someone else was going to take them over and poison them and kill them. So they put their wealth on their neck and on their body. And that's why they use the biggest, best diamonds. So one diamond at 9 carats could be worth over $900,000 and more even in some cases. So if you're worth $100 million, you buy 20 9-carat diamonds with the certificate, and you make sure you buy the best diamonds possible, etc. And you keep that in a vault at the bank. Not in your name, in the private foundation name. That's another issue. This way, in case there's a revolution or something happens with you as a person that you're getting sued, at least you have those diamonds. You have 20 million or 100 million, whatever it is. This is why it's so important. And over a 50-year period, take a look at the diamond prices. It is the most valuable investment that you could ever purchase because it doesn't cost so much to take care of that. Real estate, you need a property manager. You pay taxes every year on the income. You pay real estate taxes. Well, there's no taxes owed on your diamond portfolio. And when you sell it, exactly. This is why I say it's so important. Of course, you never sell your diamond portfolio. You sell your stocks and your real estate investments, but the diamond and gold coins, you never do because you purchase them over your entire life. And it stayed into the private foundation for multiple generations just in case something happens. Look what happened to the Romanovs. The brother of the Tsar had purchased a Cartier diamond necklace and a tiara before the revolution. It was ready about when the revolution took place. Thank God he was able to escape on a boat with his mother, the Tsar's sister, and all they had was the jewels on them. So again, they're light, you can't see them, you could hide them, etc. This is why gold bars are not such a good methodology to use, because they're too heavy. It's too much. And so I hope I've helped you out. Please remember to subscribe to my channel. Thank you so much for watching. And please remember to do thumbs up to say thank you, Anthony. Thank you so much.